It's really easy to buy the S&P 500 or the triple Q. Low-cost strategy, I get it over time. It's probably going to work beautifully, not knocking it. But if you were smart enough to listen to smart people like you and your team or others, you could have well outperformed the macro market this year.
Well, Brian, thank you for having me on again. And you're absolutely right. This is a really challenging market. And investors are a little bit confused because on one side, there is this excitement and exuberance over the market. They're bullish on the market. They continue to buy on dips. But at the same time, it's very hard to ignore the levels that the market is at. So the question is, what do we do? And would we advocate to investors that this is a perfect time to maybe not take the money off the table, but to take some profits? I mean, you just described some amazing returns. And this is the time, in our opinion, to strategically position portfolios for the next year and pivot the portfolios towards the defensive plays like healthcare, high-quality tech, financials, materials. There are a lot of great buying opportunities in individual stocks and individual sectors.
So what are we doing? You're saying now is the time, as we approach the end of the year, to start rebalancing. We are going then, Katerina, from what to what?
So, Brian, if you think about the appreciation that we saw this year, both in indexes and in individual positions and in certain sectors, we have to think strategically. We're probably going to see really strong buying, spending season through the holidays, right? Because it still is fueled by personal savings. It is fueled by the earnings that investors received in this market. But when we wake up on January 1st, the challenges that we see in this market, like supply costs, the higher costs, supply chain interruptions, the labor shortages, all of these issues are going to inevitably lead to the earnings slowdown. So what do we like? We like consumer staples. We're a little bit bearish on consumer goods, but we still like the services. Sectors like financials that are positively correlated to higher rates. And Federal Reserve is very clear about the fact that they're going to be tapering and eventually raising rates. We can expect higher rates next year. We know that. And healthcare, the aftermath of COVID is going to be felt for years to come. So there is a lot of pent-up demand there, a lot of earnings potential.
It was one of my predictions for I hate to do it, Katerina, you're right. I mean, the fact that so many millions of Americans have gained substantial weight, diabetes rates are going up, everything that goes along with that. We've got a lot of health care and mental health care issues that we are going to have to deal with for a long time, aren't we?
Absolutely. And the buying power and purchasing power of investors is no longer going to be supported by stimulus checks. So we have to dig in and we have to prepare for a more challenging market. And is it possible to make money in this market? Absolutely. We just have to be strategic and we have to prepare the portfolios for what's to come next year.